Pause whatever you're doing, because gold and silver just pulled off the kind of move that usually only happens right before the masses realize they've been sleepwalking through it all. I'm John A.G., and today's breakdown is going to be sharp and focused. New all-time highs, intense volatility, and the kind of fast moves that split the prepared from the panic buyers chasing the peak. At first glance, it looked straightforward. A big rally to kick off the week, a couple pullbacks, and a shaky close. But the real narrative is buried beneath the surface, and if you don't spot it, you'll misread what's next. Because here's what's strange. The chaos didn't happen at bargain prices. It happened at extreme ones. That changes everything. Gold launched early and hit a new record high in the mid-4600s. Silver didn't just tag along, it tried to take the spotlight, pushing beyond the low 90s. For a moment, it felt like the market was reminding everyone. When silver decides to move, it doesn't knock, it kicks the door down. Yes, the week ended cooler. Gold slid back under $4,600. Silver gave up the midday fireworks and hovered near $90. But hear this clearly, pulling back after a breakout isn't the same as falling apart. If you're holding out for that flawless dip, you could end up like most people in long cycles, watching the train leave, chasing it in a panic, then blaming the market when you stumble. So here's what we're doing today. First, I'll break down what really happened this week with gold and silver, where pressure showed up, where buyers stepped in, and why those ugly intraday drops didn't break the broader structure. Second, I'll explain why mining stocks still look confused, like they don't believe the metals rally is real, and how that disconnect could be a major opportunity if you're steady and positioned right. Third, we'll tie in the larger signals: interest rates, inflation prints, bond stress overseas, and the political undercurrent that's pushing the world toward hard assets, whether central banks like it or not. And at the end, I've got 2 questions I want you to answer in the comments. Your responses will help shape what I cover next. Quick housekeeping. My channel stats are showing something that honestly bugs me. A lot of you are watching but not subscribing. I'm not here to guilt trip you, but if this content gives you even a bit of value, hit that button. We're gunning for 50,000 subs in the next 30 days, and your click makes the difference between staying small or becoming a daily go-to for real money insight. Also, we're now uploading member-exclusive content regularly, and this isn't repackaged stuff. A full team is behind the scenes building deep dive updates only for members of the John A.G. crew. If you want in, hit join or check the link below. Now let's get into it. The headlines are simple. Record highs. The details are what count. The rally started before most people realized the week had even begun. That feeling where the market opens and it's already gone? That was this. The kind of move where by the time you check your screen, the damage or the profit is already done. Gold jumped triple digits early on, one of the biggest dollar moves I've seen in a single day. Silver blasted higher in a flash, not just up, wildly up, like it was proving again it's the more emotional sibling in the metals family. Then came the shakeout, one of those days where the market throws elbows to see who panics. Silver got hit hard, down several bucks intraday. Gold dropped sharply too, tens of dollars off the top, and if you just looked at those red candles, you might think the party was over, but by the close, the damage was milder than the fear made it seem. Gold clawed back most of the loss. Silver fought back too. So what's really going on? This is where people get misled. In a true breakout, the market doesn't move clean and smooth. It moves like a crowd. Surge, pause, surge again. The pause isn't always weakness. Sometimes it's the market checking if the breakout was legit. Now look, I'm not denying pullbacks happen. They do. But saying, I'll wait for cheap silver again is usually a dream based on a past that's not coming back. Here's the hard truth. Bargain windows don't stay open forever. And the further a trend goes, the less likely you are to get the entry you hoped for. If silver ever shows a 5x again, it'll probably be during a crisis so bad you won't even want to buy anymore. People don't go bargain hunting in chaos. They freeze. Then they buy too late, after the headlines flip from panic to euphoria. So if you're still on the sidelines, the question isn't, will it pull back? It's, what if it doesn't pull back the way I want, and I'm left behind? Now let me call something out that's been driving me nuts. If you followed this channel, you know I've said it before. Mining stocks are still behaving like they have no clue this rally is real. With gold around $4,600 and silver near $90, you'd think miners would be priced like they print money. Because when your revenue line rockets and your core costs move slowly, margins don't just grow, they explode. But what do we see instead? Mining stocks getting hammered even on minor dips in the metals, as if the market still believes this rally is a fluke. But let me ask, what even is normal? Normal is just a comfort story. The truth is harder. If gold and silver are breaking out due to stress in the monetary system, that pressure doesn't vanish just because prices wobble. In fact, that kind of wild midday selling, it's exactly what structural moves look like when big players are repositioning. They don't buy gently, they slam in, they probe liquidity, they shake the tree, then they scoop when the panic creates openings. Now let me be clear, mining stocks are not without risk. Far from it. Mines deal with real-world problems, labor issues, energy costs, politics, bad rock, hedging errors, debt overhangs, bad management. This isn't a savings account. But people accept those risks for one reason: upside leverage. When metal prices move higher, miner earnings can multiply faster than the metals themselves. That's why in strong cycles, miners can outperform. Not always, timing matters, but that earnings torque is real. And here's something most overlook. Many gold miners also produce silver as a secondary output. That's becoming more important now that silver isn't sleeping. When silver gains value, it helps cover costs. Think of it this way: silver pays the bills, gold becomes profit. So when I see miners getting dragged down, even with silver still hanging near $90, I don't see doom. I see a market that hasn't updated its mindset yet. Here's the part most traders miss. Those nasty midday dumps are often just about one thing: liquidity. Thin markets don't need massive volume to move. Once price starts sliding, algorithms smell it. Stops get hit, momentum bots pile on, and suddenly it feels like everyone's selling, when in reality, it's just one domino tipping the rest. That's why I always say, close matters more than wick. A wick is just nerves. A close shows real intent. If gold spikes, dumps, then finishes near the high, that's not weakness. That's a stress test. That's buyers saying, yes, we'll take that level. And silver is the king of emotional moves. It throws fits, fakes breakouts, then rips again when nobody's ready. If you treat silver like a tidy, logical market, it'll punish you. You have to respect what it is, a tight market that can lurch violently when real money shows up. That's also why I'm not chasing the idea of a picture-perfect pullback. Those are rare in parabolic phases. What you'll more likely get is a messy churn, a brutal fakeout, then a fresh leg higher. That's the game, to make you second-guess your own plan. Now let's talk about a narrative that's going to show up more, because mainstream coverage always needs a villain. Every time metals run, we start seeing sell warnings tied to fund rebalancing, index shifts, scheduled redemptions, something technical and intimidating. Maybe you've already seen those headlines. The suggestion that big funds are about to dump, so you should probably pause, or worse, panic. Here's how I view that. These headlines are often overblown, and when the event is real, it usually gets priced in long before the media writes it up. The real goal of those stories? Not to teach, to steer your emotions. Watch the pattern. When prices rise, they call it a bubble. When they fall, they call it a collapse. The message is always, sit tight, don't move, don't think. Meanwhile, the people who actually understand monetary cycles, they're quietly positioning and tuning out the noise. Now here's where we need to separate screen price from real-world supply. Futures move in milliseconds, but physical supply chains are slow. When demand spikes, dealers can run dry fast. Then comes the wait. That's when premiums rise. That's when the chart says price dipped, but the shop down the street raised theirs. That's when the folks who waited for the perfect entry realized they were watching the wrong screen. So if you're stacking physical, your risk isn't just price falling, it's the metal becoming scarce, that you'll either pay more, wait longer, or be left with crumbs. And silver makes this even trickier. It's bulky, it's industrial, and it can disappear from shelves fast when sentiment flips, fast enough to leave you stuck. Now, I want to do something I don't do enough. Answer 2 direct questions I get every week. Question 1. John, should I wait for a big correction before I buy anything? My answer, if you own nothing, waiting is a bet. You're hoping the market gives you a gift. It might not. A better plan? Start small. Scale in, keep dry powder for shakeouts. That way, you don't freeze or chase. Question 2. Gold is moving, but my friends say it's all just politics and will calm down. Are the fundamentals even strong? My answer: politics is a spark, not the fuel. The fuel is deficits, debt loads, and debased currency. Politics just speeds up what math already guaranteed. So even if the headlines change, the pressure underneath remains. The math doesn't magically shift just because the headlines do. And that's exactly why I'm closely watching how people are starting to talk about alternative assets. You've likely noticed the tone around crypto is evolving. When confidence is sky high, people chase the riskiest bets. But when cracks show up, the question flips: what holds up? What's real, liquid, and battle-tested? Gold answers that question clearly. Silver answers it too, with more volatility. And whether people are ready or not, tokenized tech is quietly laying the groundwork to make moving and settling metal-backed value simpler. That doesn't mean every project will work. It just means the broader direction is toward utility for hard assets. Now, if you're still here, I want you to hold this thought in the coming weeks. If the bond market starts to break down, the entire conversation flips instantly. When bonds are calm, the illusion of stability holds. But the moment yields wobble, everyone suddenly remembers the entire system is built on cheap borrowing. So if you want a cheat sheet, here it is. Track inflation, but don't get hypnotized by it. Watch real yields. If they fall while inflation stays firm, that's fuel. Keep an eye on currencies. Slow slides matter as much as crashes. Monitor bond auctions, global yield moves, stress travels, and watch silver versus gold. When silver outpaces gold consistently, that often signals broader market engagement. Now, a practical note, because this shouldn't all be theory. If you're stacking metals but stressing over price swings, set a rule for yourself and don't break it. Maybe it's buying the same amount every month. Maybe it's adding on big dips. Maybe it's allocating a set percentage of income. The point is, rules protect you from panic. Emotion is what makes people chase highs and dump lows. Rules keep you grounded while the charts play mind games. And yes, let me say this again. If you've had success, share the lesson. If you've grown wealth, even quietly, drop the core principle that helped. Was it discipline, frugality, patience, holding through boredom? Put it in the comments. That one sentence might shift someone's entire approach. Wall Street is still pricing assets using yesterday's playbook. But when the crowd's model breaks, the market forces a painful rewrite. Before we jump into the global macro angle, let me zoom in on something specific: the weekend effect. You've likely spotted it. Some of the most emotional moves happen when retail traders aren't watching. Sunday opens, thin holiday markets, overnight gaps. That's where surprises unfold. And right now, we're walking into another distracted stretch. So if your mindset is, "I'll figure it out later," understand the cost of delay. Later can be pricier. That doesn't mean you go all in blind. It means you build a plan before the market moves, not after. Now let's zoom out, because the real engine behind this metals move is deeper than any of the short-term headlines. Mainstream analysis keeps trying to package this into neat little stories. It's this one data point. It's nerves. It's a blip in the dollar. But the larger trend has been years in the making. Here's the blunt reality. Governments are broke, and the numbers don't work without inflation. That idea makes people squirm, so they ignore it, and then act shocked when gold surges like a fire alarm going off. Look at the inflation data that just dropped. The headlines spun it as positive because one metric came in slightly cooler, but the full print, still hot, and still well above central bank comfort levels. Month-over-month inflation ticked up. That's not a win. That's pressure. Annualized, still burning. And if you scroll down to producer prices, the costs businesses face before passing it on to customers, you see even more heat. That matters, because wholesale price spikes usually show up in consumer prices later. So if producers are hurting, it's only a matter of time before households feel it too. So even if a single metric comes in soft, that doesn't mean the inflation battle is over. It just means the data is noisy, while the real trend keeps marching forward. Now, why do metals care? Because sticky inflation should mean higher rates. But higher rates blow up budgets for governments, for households, for over-leveraged companies. So policymakers are stuck. They want to look like they're fighting inflation, but they also need looser policy to keep the debt machine alive. That tension, that's the fuel behind market instability. And when the instability comes from trust erosion, metals shine. Now layer this on, foreign bond stress. Japan's yields have been climbing. That might seem like a niche story, but it's not. Japan has long been a global anchor for low rates. If that anchor slips, that pressure spills out into the rest of the system. When Japan's yields climb, capital starts rethinking direction. Why take currency risk abroad when domestic returns look better? And that shift doesn't stay local. It ripples through the global bond market. When global yields creep higher, it gets harder for debt-heavy governments to borrow at low rates. That's not some abstract fear. That's mechanical pressure. And when sovereign debt starts to wobble, gold doesn't need a PR campaign. It becomes the go-to option for anyone done pretending the system is fine. This is why I keep saying gold and silver behave like early alarms. They flash before the sirens go off. They rise while officials still talk about soft landings. They move while pundits argue on air that everything's still under control. Think back to 2007. You remember the signs. Something broke early. People laughed. Then more cracks appeared. Then suddenly it was obvious to everyone. This is how cycles unfold. Not all at once, but in stages of denial. Now layer on the political climate, a machine churning out volatility, big promises, massive budgets, extreme rhetoric, bold interventions with no funding path. Even when these proposals don't fully materialize, the signal gets through. The signal is, we will spend, print, and rescue. And every time you hear whatever it takes, translate that as more currency units on the way. That's good for real assets, bad for purchasing power. And I'm not saying the dollar's about to collapse overnight. It doesn't need to crash to lose value. It can just quietly leak purchasing power while you watch prices for food, rent, and healthcare drift higher. Sometimes a currency crisis doesn't feel like a collapse. It feels like your paycheck shrinking in slow motion. There's another layer that keeps getting ignored: trade balance and currency trust. When a nation runs constant deficits, it needs to finance them, and that depends on foreign confidence. If that trust fades, raising money gets harder. Yields rise, and central banks are left with two bad choices: allow rates to spike and risk a recession, or intervene and risk inflation. Once again, they're boxed in, and history shows metals tend to perform best when policymakers run out of clean exits. Now I know what some of you are thinking. I can already see it coming in the comments. John, what if this is just the top? What if this is where it all reverses? Here's my honest take. Pullbacks do matter, but context matters more. Tops usually come with celebration, not hesitation. They arrive when everyone's bullish, when random people are shouting price targets, when strangers start giving metal advice. We're not there yet. Most people still don't believe this rally is real. They're calling it a fluke, waiting for the magic dip, still thinking things will normalize. That's not peak exuberance. That's early cycle disbelief. You can see it in behavior. Even at record prices, physical demand isn't in mania mode. The masses aren't stampeding into gold and silver. That quiet skepticism, it's exactly what makes this rally more durable than it looks. So let's shift for a moment. What do you do with all of this without making emotional decisions? First, let go of the fantasy of a perfect entry. You won't time it exactly. In real markets, you either act with discipline or chase with regret. Second, build in stages. Don't go all in, don't stay all out. Add in layers, rebalance, manage downside. One red candle shouldn't destroy a long-term thesis. Third, distinguish between types of exposure. Holding physical metals is different from owning miners. One is long-term monetary defense. The other is a business tied to extraction, costs, and leverage. Don't treat them the same unless you truly understand the risk profile. Fourth, watch premiums. A drop in spot price doesn't always mean cheaper metals on the street. If physical supply tightens, premiums can rise. That's why you might see silver at $87 but dealers charging $96. It's not manipulation, it's suppliers' demand at the retail level. Now here's something I don't say enough, and I need your help on it. If you're one of the people doing well, maybe you bought early, maybe you held through flat periods, maybe you just stayed consistent, please share that in the comments. Not to flex, but to encourage. Because when someone sees that real people, not influencers, not suits, made calm, steady moves and stuck with them, it builds conviction. It helps others stay level when things get shaky. And if you're not there yet, that's okay too. Be honest. Share what's been tough: timing, fear, budget, patience. This community becomes stronger when we drop the act and speak truthfully. Now here's your hook for what comes next. And it's the part few want to hear. If inflation keeps grinding higher and rate cuts stay on the table, bonds become the battleground. And when bonds start flashing red, the move in metals can go from strong to violent. That's what people don't see coming, because our whole financial structure is built on belief in government credit. If that belief starts to slip, everything gets repriced. So yes, keep watching gold and silver, but start watching the bond market even closer. Look at yields, watch auctions, track overseas flows. That's where the next signal comes from. Keep an eye on signs of softening demand. Pay attention to how officials speak when they're under pressure. And as you do, remember this: markets often break in corners no one's watching. Now let's bring this back to real-world action. If you're new here and wondering, okay, so what now? Here's the no-hype answer. If you have zero exposure to precious metals and believe we're heading into monetary turbulence, your job isn't to find the perfect entry. It's to get started. If you're already in, your job is managing risk. Don't let excitement push you into oversized bets, and don't let fear scare you out of what could be the best trend of the decade. Looking at mining stocks, focus on quality and patience. The market can misprice them longer than seems logical, but when sentiment shifts, those moves happen fast. And before we move on, one quick thing. Most of you watching still aren't subscribed. If you want these weekly rundowns, the shorter updates, and our deep dive breakdowns, hit that button. We're aiming for 50,000 subscribers in the next 30 days. If you're already watching, you're part of this. Make it official. Also, check the description. It's packed with extras, links to the premium WhatsApp channel, our membership access, and a few tools to help you track levels without needing to babysit a screen all day. Now let me explain what you actually get with membership, because it matters. Members-only videos are powered by a dedicated research team who dig deeper into complex topics. We're talking curated data, structured reports, side-by-side comparisons, the kind of material that takes real hours to produce. These insights don't fit into public uploads. That's why they're exclusive. When you join, you're not just supporting the channel, you're backing a process that delivers real research every week. And if today's video helped you think more clearly, pass that value on. Share it. Help someone else avoid the traps you've already learned to dodge. Back to the markets. One thing that jumped out this week: how fast buyers showed up after those pullbacks. That doesn't guarantee anything, but it's meaningful. When bids keep showing up at higher levels, the market's not aiming for old floors. It's building a new ceiling. That's how breakouts behave. Surge, pause, grind, surge again. Now let's tackle a common trap. A chart moves up quickly, and people assume it must reverse just because it looks too fast. Sure, sometimes that's valid, but often a fast rally is the start of a repricing, especially in under-owned assets. Here's the key idea: the marginal buyer changes the game. When markets shift from casual retail interest to serious institutional positioning, the behavior changes, and I think we're entering that transition. Not fully there yet, but moving in that direction. To make this less abstract, let me break down the logic in 5 steps. Inflation is still alive. Policymakers are incentivized to downplay it. High debt levels force them toward looser monetary policy. Easier money weakens purchasing power. Real assets respond. Gold leads. It's the cleanest monetary hedge. Silver comes next, smaller, more emotional, but explosive once attention locks in. Other metals follow. Miners lag, because equities react slower, especially when mainstream media still treats metals like a niche. But once public awareness kicks in, that polite price action disappears. Does this play out in a straight line? No. On your timeline? Probably not. But once you see the pattern, you stop being rattled by every pullback. And I promised I'd keep this focused, so let's close strong, with 2 questions for you to answer in the comments. First, do you think silver's next move will be a slow, steady grind, or a sudden spike that takes everyone off guard? Second, what's your biggest challenge right now? Getting the courage to begin? Having the patience to hold? Or figuring out how to allocate between metals and miners? Your answers guide what we dig into next. And if you're someone who's had success, even quietly, share it. What worked for you? Was it consistency, simplicity, cutting the noise? Or if you've made some mistakes, be honest. That helps people more than any chart ever will. That's it for this week's wrap. If you get value from this, subscribe. We're pushing to hit 50,000 strong in 30 days. Description has all the extra links, WhatsApp channel, membership, and tools. And remember, the members-only deep dives are now live, supported by a real research team, and built for people who want more than surface-level commentary. Take care of yourselves. Take care of each other.